The year is 2030 and home prices won't stop climbing, and now homes are 46% higher now than they were during the pandemic, leaving thousands who want to buy a home but simply can't afford it, making people introduce a crazy solution called the 40-year mortgage. You can tell that prospective homebuyers are desperate for a solution in order to finally afford a home, as FHA 40-year mortgage 2023 searches have jumped by 2,600%. Hi, my name is Austin, and in this video we'll be discussing the 40-year mortgage that everyone is talking about, and then we'll see if it makes sense for you and what the best options are. The typical mortgage products offered are a 15-year mortgage and a 30-year fixed rate mortgage. And the reasons why someone would choose a 30-year mortgage over a 15-year mortgage is the increased buying power it gives you. For example, if you make $60,000 a year and you have a $20,000 down payment, with a 15-year mortgage, you will be able to afford a $170,000 house. Now, if we look at the same income for a 30-year mortgage and the same down payment for the same house, you could afford almost $200,000 for the home. And that's a $30,000 increase, which can be the difference between getting in that neighborhood that you want, or getting a good school for your kids, or even just being able to afford a home in the first place. So you can see how increasing the length of your loan can be beneficial to people, and that's kind of the idea behind the 40-year mortgage. So later we're going to go back to the math and I'll show you the different interest that you'll be paying between the different three loans: 15-year, 30-year, and 40-year. But first, we need to talk about the 40-year. And the 40-year mortgage was just given the green light by the Federal Housing Administration in the second week of March. And since everyone is talking about it, it is a brand new thing, and it's not what it seems like. First, unlike the 15-year and the 30-year mortgages, the 40-year mortgage is not a mortgage. It's actually a loan modification for an existing loan. So if you're a first-time home buyer or you're looking to buy a house, you're not going to be able to use that 40-year mortgage. This is a modification for existing loans. Brian Rugg from Loan Depot said, "The loan modification is a program offered by lenders and designed to avoid more dire outcomes, such as foreclosures or short sales, when a borrower is struggling to make timely mortgage payments." I don't even want to spend a bunch of time on who can get the 40-year mortgage, because I think this next part is going to show you a reason to think twice about it anyway. So let's hop into Excel really quick, and I want to demonstrate how much interest you'll be paying for each of the different types of loans. At the time of filming this, interest rates for a 30-year are around 7%. For the ease of demonstration, I'm going to use 7% for all three types of loans. But the 15-year loan is going to be the lowest percentage. So these numbers will be even exaggerated even more. But for the demonstration purposes, we're just going to use them all at 7%. Running through our demonstration here, we have a 7% interest rate, and the terms of our loan is 180 months, or equivalent to 15 years. The loan amount is $200,000. So for our monthly payment, we're going to be paying $1,798. At the end of the mortgage, our total cost for the home will be $322,415. And our total interest pay will be $122,000. This is going to be our baseline. So now let's move on to the 30-year mortgage. Now on a 30-year mortgage with the same $200,000 principal, we're going to have a payment of $1,331. So significantly smaller than the 15-year mortgage. So keeping everything the same and changing our terms to a 30-year mortgage with the same $200,000 principal, our new monthly payment will be $1,331. And this is going to be about a little under $500 difference between this and the 15-year mortgage. But here's where things get interesting. Our total interest paid will be over double, and we'll be paying $277,852 in interest, and the total home will cost $477,852. So by just getting a lower payment, you're going to nearly double the cost of the home to you. So you're almost paying $500,000 for a home that only costs $200,000 to begin with. Now let's move to a 40-year mortgage. So the calculator starts to mess up with the 40-year mortgage because it's not really normal procedure. Normally 30 is the maximum amount, but for the same information, just 40 years instead of 30 years, we're going to have a monthly payment of $1,243. Our total interest paid has gone up once again to $353,000. And then the total cost for the home has gone to $553,000. And remember, it started at $200,000. So just by increasing the term limits, you're actually paying significantly amount more in interest. So let's compare again. With the same interest rates, the 15-year mortgage, you pay $1,800 a month. You only spend $120,000 in interest. For 15 years, you pay $1,300 a month. $500 a little bit better, but you're paying almost $300,000 in interest. And then going over to 40 years, which this is the big difference between 30 years and 40 years, should be a bigger difference, but you're paying an extra, let's go to interest first, almost $80,000 extra to have a lower payment of less than $100. That's why the 40-year mortgage makes 0 sense. You're paying significantly, you're $80,000 for an extra $80 a month. Does not equal out. Not worth it. This just goes to show you that how during high interest times, it is so expensive buying a house. So hopefully now that we can tell that those small benefits of having that extra 10 years on our mortgage is probably not worth it. I even think it's slightly dishonest for even releasing something like that to the public. The crazy high interest you'd be paying over those extra 10 years is just not worth it. Your payments are barely smaller, and it hurts just spending all the extra money on virtually no benefit. Here are my thoughts. The shorter the loan term, the better. Longer loans, you end up paying just more in interest, and for a 30-year mortgage, that would end up paying almost double the cost of your home over its entire life. Picking out which mortgage length is right for you comes down to how much you can afford on a monthly payment. The 15-year is shorter, and you'll pay much less interest at the cost of a higher monthly payment. If you can do a 15-year mortgage, that would be ideal, but only if you can make it fit into your 50-30-20 budget. So if you can fit all of your expenses with a 15-year mortgage and do 50% of your income budget, then it would be a good option. But for most people, the 30-year mortgage is what people are going to go with. But when you take that, always remember, if you don't have a great rate, then refinancing down the road with a better rate in shorter terms is a great option. So maybe you have a 30-year now, but you look to move to a 15-year later. On the other hand, if you have a good mortgage rate that's around 3%, it's probably going to be best to keep your rate. 3% is a great mortgage rate, and we probably won't be seeing those numbers anytime soon. And the 40-year mortgage is going to have much higher rate. It's no good. 40-year, no good. So I hope this video was helpful. Please give it a like for the YouTube algorithm. It helps me out so much. Subscribe for more content, and I will see you in the next one.